Alright, let's dive into this because it's a fascinating moment in the markets, and Poole's latest picks are a perfect lens to explore what's really going on. Here's the thing, the markets are climbing what she calls the wall of worry, and personally, I think that's a brilliant way to frame it. We're seeing robust corporate earnings and this massive AI investment wave, but there's this underlying tension, narrow market breadth, momentum-driven gains, that feels like walking a tightrope. What makes this really interesting is how the second quarter played out. Remember those sharp gains in hardware and semiconductor stocks? Classic boom and bust sectors, right? But here's the twist, the correction we saw in July wasn't a red flag, it was actually a healthy sign. Markets are broadening out, and that's a good thing for long-term stability. Now, let's zoom in on the Canadian economy because it's a mixed bag. GDP is finally showing signs of life after 2 quarters of contraction, thanks to exports and business investment. But here's where it gets tricky, household purchasing power is still squeezed, and that new 50% tariff on Canadian exports to the US. That's a wild card. In my opinion, this feels like a negotiating tactic more than a done deal, but it's a reminder of how fragile trade relationships can be. And the Bank of Canada? They're likely on hold with rates, which makes sense given the weaker GDP and trade uncertainty. But here's the bigger picture, Canada's long-term growth story is tied to policy clarity and diversification. It's not flashy, but it's steady. Meanwhile, the US economy is flexing its muscles. GDP growth is solid, manufacturing is booming, and AI spending is anchoring business investment. But, and this is a big but, inflation risks are lurking. Middle East tensions, tariffs, and AI demand could reignite price pressures, and that's something the Fed will have to watch closely. What this really suggests is that we're in a delicate balance, growth is there, but so are the risks. Now, let's talk about Christine's top picks because they're not just stocks, they're a playbook for navigating this environment. First up, Siemens AG. This company is a powerhouse in industrial technology, and what many people don't realize is how well positioned it is for the AI, automation, and electrification trends. It's not just about selling hardware, it's about enabling the infrastructure of the future. Personally, I think the 2% dividend yield is a nice bonus, but the real story here is its secular growth potential. Next, Stryker. This one's a medical tech giant, and here's what immediately stands out. Its dominance in the US orthopedic surgical robotics market, 75%. That's massive. But what's even more compelling is the demographic tailwind. Aging populations mean more joint replacements, more surgeries, and more demand for Stryker's products. The dividend yield is modest at 1.1%, but the growth story here is undeniable. Finally, Pembina Pipeline. This is a classic energy infrastructure play, but what makes it stand out is its cash flow resilience. Nearly 70% of its cash flow is backed by long-term contracts, which means it's not at the mercy of commodity price swings. And that 4.4% dividend yield? That's income investors' dream. If you take a step back and think about it, Pembina is a hedge against volatility in a sector that's often anything but stable. Here's the broader perspective, these picks aren't just about riding the current wave, they're about positioning for the long term. Siemens is playing the tech and infrastructure game, Stryker is betting on demographics and innovation, and Pembina is about stability and energy. What this really suggests is that in a market full of uncertainty, quality companies with strong balance sheets and clear growth drivers are the ones to watch. But here's the deeper question, are we overestimating the AI boom? I mean, yes, it's transformative, but history tells us that cyclical sectors like semiconductors can overheat fast. The correction we saw in July could be a preview of what's to come. And that's why I think Christine's focus on high-quality, profitable companies is spot on. It's not about chasing the hottest trend, it's about finding companies that can compound capital through cycles. So, what's the takeaway? Markets are climbing that wall of worry, but the key is to stay disciplined. Christine's picks aren't just stocks, they're a strategy. They're about growth, resilience, and income in a world that's anything but predictable. And personally, I think that's a playbook we could all learn from. What do you think? Are these the kind of companies you'd want in your portfolio right now? Let me know in the comments, I'm curious to hear your take.